Good morning, students. How are you all? Hope you all are fine. Okay. Okay. Shall we learn accountancy? In accountancy, in the seventh lesson, we are, isn't it? We just started that lesson. Company accounts. We know about company, that joint stock company, how it was formed, isn't it? We started to learn in commerce. There we will learn in detail about this company form of organization. Here we should learn how they prepare the accounts, how they maintain books of accounts, that joint stock companies. Okay, before going to learn the accounts, we should learn some more thing, that is issue of equity shares. Yesterday we have studied about the difference between equity shares and preference shares. Preference shareholders, they have some preference at the time of receiving dividend and at the time of winding up to receive the capital back. Okay, but equity shares are the ordinary shares, but the equity shareholders are the owners of the company. Okay, how they issue shares, that we will learn. There are four methods they can issue equity shares to the public. Okay, first one is public issue. So what is public issue? Here a public company will issue shares to the public. Okay, so that means issue of equity shares to the public by a public company through prospectus. Okay, yesterday also I have told you they will issue a prospectus, publish a prospectus. There only they will enter all the details. Okay, so through prospectus they will issue, that they will publish one prospectus, that is called public issue. Okay, here this public issue can be made either for initial public offer, that means at the beginning of starting a company. Okay, at the time of formation of a company. Okay, incorporation of a company, or that further offer in the middle of the life of the company also they can issue this share. Okay, that is called initial public offer, further public offer. Okay, IPO it is called. Okay, in these two ways they can issue. Here they are issuing these equity shares to the public by a public company. Private company will never issue share for the public. Public means the ordinary people. All the people all over the world, that country can buy the share of that particular public company. Okay, that they can do either for initial public offering or for further public offering. Okay, then second issue of equity share is private placement. Here why it is called private placement, they will not issue this equity shares to the public, but it is a private offer. Okay, maybe a selected group of persons will be there. For them they will send a letter, issue letter. Okay, or a private placement offer letter will be sent to those selected group of persons. Okay, so when they issue this private placement offer, they should satisfy the conditions specified in section 42 of the Indian Companies Act 2013. Okay, so section 42 will explain what all things they have to fulfill before issuing that private placement offer. Okay, then the third one is rights issue. Here that means at the lifetime of the company, in between, not at the initial time. So at the lifetime of the company, the equity shares will be issued to the existing shareholders. Already shareholders are there. For them, they will issue shares through a letter of offer. Okay, that is issuing shares to the existing shareholders is called rights issue. Okay, then the last one is bonus issue. This is also for the existing shareholders at the time of lifetime of the company, but at free of cost. Okay, because if they have that accumulated profit, more profit, okay, from that profit they will issue, they will compensate that cost from the accumulated profit of the company. So it will be issued freely for the existing shareholders, okay, from the accumulated profit. That is called bonus issue. So now you might have understood the types of issue of equity shares. Now the process, how, in which way they are issuing share, that is called the process of issue of shares, equity shares. The first one, they have to publish a prospectus, isn't it? That inviting subscription. Inviting subscription. Many provisions are there. They have to follow the provisions of Companies Act or the guidelines given by Securities and Exchange Board of India, SEBI. Okay, as per their wish, they cannot issue shares, but they should follow the provisions given under the Act and the guidelines of SEBI. But this is the usual procedure. Okay, inviting subscription. So here we will learn about a public company how issue share. Okay, private company, they never issue shares to the public. Okay, what we are learning is related to the public company. Okay, so a public company has to issue the prospectus. Okay, that prospectus, and it is inviting the public to subscribe for their shares. Okay, that is the first step. Okay, next, that means they will publish in a newspaper, a famous newspaper, where that newspaper that is circulated all over the country. Okay, which area they related to contact, get shares, they will publish that one in that gazette or in that newspaper. Then the public will see, they will read the regulation, rules and regulation that is given in the prospectus, and if they are satisfied, what they will do, they will apply for the shares. That is the next step, receipt of application. So all the details will be given. If they are satisfied, they have to apply with the minimum amount, that is called application money. Understand? And a particular bank address will be given, scheduled bank, a nationalized bank, that is called scheduled bank. Okay, they have to deposit the applications along with the application money in the bank within the time limit, within one month, or the time limit with on or before 30th November, okay, 2020, like the time limit, specified time limit will be given. Within the time limit, they have to apply for the shares of that company in that bank. Here, there is one rule, the application money must be at least 5% of the share value of the shares. Okay, the face value or nominal value of the share, 5% it must be. Okay, so they, after receiving the share, that application money and the applications, they will do the next process, that the third process, allotment of shares. The same thing we are going to learn in the commerce also, allotment of shares. So there is one minimum subscription amount. Okay, minimum subscription they have to receive. If they have received, before we one 90% of the that issue of shares, issue price. Okay, if they have issued for 1 lakh, at least 90,000 shares must be subscribed. Okay, now we will see. So if they have received the minimum subscription given in the prospectus, the company will allot the share. That will be done by the board of directors. Okay, so they will allot the share for the applicants. Okay, the applicants. Some applications may be refunded if they receive more applications than the shares that they have subscribed, they have issued to the public, then they have to refund some of the shares. That we will learn in which basis they are refunding. Okay, so if they refund any share application money, that will be stated. Okay, then if the minimum subscription is not received, okay, 85% of the issue price only they have received for us applications, what they have to do, they have to refund the full 85% of the shares. So they have to cancel the issue. Okay, next, this issue can be done either for cash or for consideration other than cash. That means for any asset, okay, maybe the land, building, that will happen in the beginning. Okay, then in the lifetime of the company also sometimes it may happen. Okay, so either the shares will be issued for cash or it may be issued for consideration other than cash. If it is issued for cash, what are the procedure they have to do? Okay, here when they have to receive the cash in 4 installments, either in installment or in one installment as a lump sum. Totally, the full share can be received. Nowadays they receive in full as one installment only. Okay, before it had 4 installments. The first installment is called the application money. Okay, the first one is called application. The second one is allotment money. Third one is first call. The fourth one, second call or the final call. Okay, that the company has at least 3 calls they can make. Okay, not at least, at the most they can make 3 calls or minimum 1 call. Okay, so here they are receiving the application money, then they do the allotment, they will receive the allotment, the remaining as allotment money, then they have to make the call money. They after some time only, not every at the beginning itself. After many months they may call for this call money. Okay, here when they make the call, there must be at least 1 month gap. Okay, 1 month gap should be there. And one more rule, each call may not have more than 25% of the face value of the share. Okay, less than 25% of the face value of the share only must be called for one call. Okay, each call should not contain more than 25% of the face value of the share. Okay, here again, these shares can be issued at par or premium. Par means at the face value. If it is 10 rupees, okay, 10 rupees. If it is for premium, they may issue for 12 rupees. So, what is the premium? 2 rupees is the premium. So, they can issue the price issue the shares for a price more than the face value of the share, that is called premium. Okay, that is the profit for the company. Okay, now you are going to learn the journal entries. Okay, so be very careful, and you have to write the journal entries. How? When we issue shares at par, premium, the little difference in only one entry. Okay, so first one, at the time of receipt of application money. Okay, bank account debtor, journal entries. Okay, journal entries you can write. Bank account debtor to equity share application account. Being share application money received, or equity, everywhere you can write, or you can write simply also equity share application money received. Okay, then they will give for each amount. If it is for 10 rupees, that application money 2, here 4, here 2, final call 2. Then how many shares we should see, how many shares they have applied. If it is 10,000, so 10,000 into 2, 20,000. Okay, that way you got to write the amount also. Then we need to transfer this application money to share capital. Okay, so here equity share application credited, we need to debit. Okay, equity share application account debtor to share capital. Equity share application money transferred. Money transferred. Transfer to share capital account you can write, or simply. Okay, 2 entries. Now each entry for each process. Okay, and first one, when we receive share application money. Second one, we transfer the share application money to the share capital account. Okay, because this is called the share capital, a part of share capital we have received. Okay, so equity share bank account debtor to equity share application account. Next one, then equity share application we are debiting, transferring. So equity share application account debtor to share capital account. Then if we refund any amount, okay, if we receive more applications than that we have subscribed, we have issued to the public, the excess share application money must be refunded. So the same thing, equity share application account debtor to bank account, the opposite of the first entry. Okay, we are paying back. Excess application money refunded. Okay, if there is any excess application money, we should refund. Then that allotment, to do the allotment. Here this second entry will be the base. Okay, equity share allotment account debtor. debtor to share capital. How much money they have to allot. For allotment, how much money they can allot, they will decide. Okay. And they will write equity share allotment due. Due. Okay. 10,000 shares into 4. 40,000. Okay. Then next they will receive the share allotment money. So what is the entry? Bank account debtor to equity share allotment account. Again, equity share allotment money received. Okay, if you learn this fundamental entries correctly, then it will be easy for you to do any adjustment. 1 or 2 entries will be more or less. Okay, there will be a change, little change in these fundamental entries. Then if we make the first call due. So equity share first call account debtor to share capital account. But you have tried equity share first call money due. Okay. 2 we have given, isn't it? So 2 into 2, yeah, 20,000, 10,000 shares, no? Then when we receive the amount, bank account debtor, repeatedly it will come, but you should be little careful, that's all. Bank account debtor, then this debit must be credited. Equity share first call account. Then equity share first call money received. Okay, then final call. The same thing. Okay, 6, 7, 8. First call, how you should write? Second and final call. That word final should be there. Okay, second and final call account debtor to share capital account. Here what we should write? Equity share second and final call money due. Okay, then next one, bank account debtor to equity share second and final call account. Equity share second and final call money received, that amount. Okay, so totally 8 or 6. If as per the question you have to write only first and final call. Okay, you have to write as it is given there. Okay, students. Yesterday we have marked some of the question answers. We will see. Or we will see one illustration. Okay, see the illustration. Thai Limited issued 1 lakh equity shares of rupees 10 each, payable 5 on application, 2 on allotment, 2 on first call, 1 on final call. All the shares are subscribed and amount was duly received. Past journal entries. See, first one, bank account debtor to, here also we are written, bank account debtor to equity share application. See, bank account debtor to equity share application account. Okay, then how we got this amount 5 lakh? See, how many shares? 1 lakh. Then application amount 5. 1 lakh into 5, 5 lakhs. Okay, then next one, application money received. Then equity share application account debtor to equity share capital account. Transfer of share application money to share capital. Okay, then equity, second one, 2 over, second process allotment, isn't it? So we have to take the second entry as the base. See, equity share application, here you have to change that application word into allotment. Equity share allotment account data to equity share capital. Here you should not write this one, transfer. Share allotment money due. Okay, then amount we will get the number of shares into allotment amount 2. 2 into 1 lakh, 2 lakhs. Okay, then we receive the allotment money. Bank account data to equity share allotment account. Okay, allotment money received. Then the equity share first call account data to equity share capital, share first call money due, then same amount 2 rupees. Okay, then receiving first call money. Okay, bank account data to equity share first call account, share first call money received, same amount. Then second and final call. Okay, final call given, but we should write equity share second and final call account data to equity share capital 1 lakh, 1 rupee. Okay, then to share capital account, share second and final call money due. Last one, bank account data to equity share second and final call account, share second and final call money received. So now we will do one problem. Okay, see, Progress Limited issued 50,000 ordinary shares. Ordinary shares means equity shares of rupees 10 each, payable 2 on application, 4 on allotment, 2 on first call and 2 on final call. All the shares are subscribed and the amount was duly received. Pass journal entries. Okay, so you have to write like this. Okay, now I am not writing, but I will change and give. You have to write. Okay. Here, bank account data to equity share application account. Equity share application money received. Here 50,000 shares into 2. So how much? 1 lakh. Okay. Then share application, equity share application account data to share capital. The same amount, isn't it? Then 2 application, then 4 on allotment, 4 rupees. So equity share application account data to bank account. So this one will not come. Okay, excess. No excess. Okay. Then the third one, equity share allotment account data to share capital. How much? 50,000 shares into 4. So 2 lakh. Okay. Okay, then first call 2 rupees. 2 rupees into 50,000, 1 lakh. Okay, first call. Then final call. So there you have to write 6. Okay, that second and final call account, same amount, isn't it? 2 rupees, same amount. Okay, I think you have to write this entries in your book. Okay, students. Here we have to mark some of the question answers. What is a share? Yesterday I have told you to mark, isn't it? Share. Meaning capital. These 2 points. Okay. The first question. Then difference between short answer, preference shares and equity shares. That one you have to take in the guide. Okay. That guide page number 200. Okay. that it, now you do not need to buy the guide. I will write and put when once the schools reopens. Okay. Then short note on authorized capital and reserve capital. Authorized capital, then reserve capital here. Okay, only this much, and you do that exercise 1. Okay students, thank you very much.